Hello and welcome to Smartvalues Talks. I'm your host Soumitra Sengupta. Today we will be talking to Soumitra Sengupta. Soumitra has been in the financial services industry for over 30 years and has extensive experience in product and risk management. He has been a professional trader and investor for over 2 decades, using quantitative systems to deploy funds in the stock markets around the world. He is a chartered accountant from India and has an MBA degree from Syracuse University. Soumitra and his team have recently launched the portal Smartvalues. Hi, Soumitra. Good morning.
Hi, Mamta.
So tell me, Soumitra, what is Smartvalues?
Okay, Smartvalues is a digital platform that hosts portfolios or pouches, as we call them, that investors can then register and subscribe to. These portfolios are created by our proprietary software using AI techniques. The pouches are created on different bases. The pouches could be thematic or sectoral or segmented, like as in large cap segments, so mid cap and micro cap and so on.
Okay. There are many digital platforms. So how is Smartvalues different?
Well, in many ways, but let me just give you the configuration of the platform. It's built on an Angular front end with a backend microservice in Golang and is hosted on the AWS cloud. So it's easily accessible from anywhere in the world. It is very user-friendly and easy to navigate. Subscribers can register, complete their KYC, pay their subscription, and invest seamlessly. The platform is integrated with various payment channels so that you can pay your subscription through debit or credit card, net banking, or UPI. The platform is also connected to about 14 to 15 brokers through whom you can execute your trades. Your trades are reported in an easy to understand format and gives you a complete list of your transactions in a transparent way. But this is not the only way in which this platform differentiates itself. The pouches themselves, or the portfolios themselves, are created by our proprietary software, which has been used for over a decade. The algo uses momentum to create portfolios and maintain the portfolios based on certain trend following rules. We use strict stop losses to mitigate risks. However, we do not have profit targets and stay with trends as long as it goes. You might agree with me when I say that having price targets tends to be very erroneous, and so we don't go there. We just follow the trends as far as it goes. We go wherever the market takes us.
That's great. You talked about proprietary software. Now, what is so special about it?
Well, our proprietary softwares use algorithms to create and maintain the pouches or portfolios. Algorithms are just a fancy way of describing a rule-based system. Our proprietary algos uses such rules to create these pouches, which involves buying, selling, and staying invested in stocks. We use momentum and trend following rules to create and maintain these portfolios. We use stop losses to mitigate risk, but do not work with any profit targets. In a way, you can say that for us, the market itself is the fund manager and we just follow it. The rules of the algo follow the old trader's dictum of cutting one's losses and letting the profits rise. As I said, we do not have any profit targets. Therefore, the trades comprise of some small losses and a few large profits. There is a tax advantage to this as well, because profitable trades mostly have a duration of more than 1 year. This makes them taxable as long-term capital gains, where the tax rates are lower. Momentum is usually associated with frequent trading, but since we work with long-term momentum, our trade duration is long, and so rebalances are infrequent. We believe that all in all, the product is differentiated and provides a compelling proposition to those who wish to invest in stock portfolios. Investing in stock markets can be tricky and challenging. The challenges include the need to process a plethora of information, analyze company data and macro data, understand the geopolitical scenario, and much else. There are also many behavioral issues that result in people losing money. The advantage of using a platform like Smartvalues is that you can just follow the algorithm, do your trading based on the algorithm, and you don't have to bother with this plethora of information that keeps happening and keeps bombarding you and confusing you.
Okay, that really sounds interesting. Now, did you say that we tend to be biased in taking investment decisions? So, what are some of these biases?
Well, Mamta, the advantage of having a algo is that softwares don't have emotions and they do their or take their decisions on a absolutely objective manner. We human beings have many emotional biases that cloud our judgment. A software doesn't have it, an algo doesn't have it. And this is particularly the role of emotional biases and the biases getting in the way of taking correct or optimal investment decisions is very well recorded and very well understood. Some of these biases are loss aversion, confirmation bias, and anchoring bias. So let me go into these in a little bit more of detail. Loss aversion is the reluctance of people to take losses once they occur. Now, as you will appreciate, I mean, we cannot go through our investing career with only having profitable trades. There would be some losing trades. If you're doing well, there would be fewer losing trades than winning trades. But these losing trades have to be recognized early so that the damage it does to your portfolio is reduced or minimized. There is something called the confirmation bias that is also very, very important and plays a very significant role in hindering the quality of our investments. When we invest in a stock or on a thesis based on certain information or certain news, we tend to filter out any information or any news that we subsequently get which does not support or corroborate our original thesis. We only tend to stick to news and information that confirms our thesis while ignoring all the news and information that negates our thesis. This inhibits our ability to recognize when we have gone wrong or where we have gone wrong and has a very damaging effect on your portfolio. And third bias is the anchoring bias, which is similar to the confirmation bias. We tend to get anchored onto things. And one of the most important ways in which this can happen is when we get anchored to a price. So, for example, if you have bought a stock at, say, 700 rupees, we tend to get anchored to that price of 700 rupees. But that the price at which we bought it has no significance in terms of the market process and the market flow. It's just that we bought it at that price. It is important to us, but it is important to nobody else. We tend to get anchored to these kind of numbers and events and outcomes that we think will happen. And this can also hinder our ability to have optimal investment decisions. If you want to know more about behavioral biases, I have put a link to another webinar of mine on this subject, and you can go through it in greater detail. I talked about 10 habits that keep you poor, 10 habits that make us suboptimal investors.
Okay, that's nice. If viewers can get a link to
yeah, it's there in it'll be there in the below.
Now, words like this sound very intimidating to the average investor. So what comfort do they have that things will not go wrong?
Yes, it does. I mean, we use words like algorithms and behavioral biases and things like that. Those tend to sound very intimidating, but algorithms are just a clever way of saying, specifying that we are using a set of rules. The portfolios are constructed using a set of rules and are also maintained and rebalanced based on these rules. The algo provides the subscribers with a set of options and suggestions, but the execution is not done automatically. The subscribers have to agree to the recommendations digitally. There is a link, and only then will the trades get executed. So the role of the algorithm is to come up with suggestions that will go to the subscriber, and then it's up to the subscriber to accept or not accept those suggestions. Now, there is really no fear of an algo running amok and doing things on its own. We have given the subscribers the best of both worlds. Stock recommendations based on an objective parameters that is embodied in the algo, but not compromising on his ability to keep control.
Okay. You said execution will be done by the system. So how can a subscriber invest in Smartvalues portfolios?
Well, the portal is integrated through to 15 leading brokers. If the subscriber has an existing account with any of these brokers, then he or she can execute in these broker accounts. The execution is done seamlessly. There will be a link, and once you click on the link, the entire portfolio gets executed. There is no need to transact the stocks individually. So, for example, if a portfolio has 10 stocks, you do not have to go and individually buy all the 10 stocks. You can just click on the link and all 10 stocks and the entire portfolio gets executed. There is similarly in the case of rebalance, if the rebalance link is clicked, the system will automatically take the stock that is to be sold from your demat account and buy the rebalance stock and put it into your demat account. If a subscriber's account is not with any of the brokers integrated to the platform, the subscriber can then execute the trades offline with his broker and manually enter the trades in the portal. So all subscribers can avail of this portal and the portfolios and subscribe and invest in them, irrespective of which broker he or she has.
Okay. But markets and regimes, they change. So how does the system take care of that?
They do indeed, Mamta. Our algorithms have been in the market for over 10 years and has withstood many market changes. Now, let me elaborate a bit on this. The system is robust because inherently it is not predictive. The algos assess momentum of the market and follows it. In effect, this process, you can say the market is the manager and we just follow it. So by definition, the market cannot be wrong about itself. And because we are not in the game or in the business of predicting, but following, the algo tends to remain robust across different market regimes. Another reason that the algo is robust is because it's not optimized. You can get many systems where the backtested results on paper are very good, but when they are used for live trading, they do not perform so well. This is because they're optimized to the period for which they are being backtested. In order to get the very good backtested results, people tend to optimize the back-ended results, but the rules that emerge from those backtesting, in fact, I wouldn't even like to call it backtesting. It's basically backfitting. We're just fitting our rules to the data that we have. And so since the markets do not exactly repeat, those rules don't perform well when they are tested against the live market. The markets are never identical, and backtested results, especially backfitted results, cannot be replicated. When we do our backtesting, we take a lot of care to ensure that we are not backfitting our rules to the existing data. It is very easy to understand what I mean by this example, what I mean by the difference between backfitting and backtesting. Let us take some market data, which by definition has to be finite. If we feed the data to a supercomputer and ask for a rule that maximizes for profits, it would be able to do so without much difficulty. However, the rule that it gives will not work in real market conditions because the market conditions are never identical. Uh, Market processes and market dynamics are similar, but never identical. Mamta?
Okay, okay. So talking about risks, a big risk is in the custody of the assets, right? So once a subscriber invests, who has the custody of the assets?
Well, with Smartvalues, the subscriber executes the trade in his own trading account and demat account, and the stocks so purchased remain in his demat account. So at no time during the period, the subscribers lose custody of the assets. In a manner of speaking, the subscriber is actually never out of funds, Mamta. I mean, it's like, when you go and buy gold, let's say, and put it into your vault, would you consider yourself to be out of funds? No, because the assets are with you. So in a similar way, when you are investing through Smartvalues, you always retain custody of the assets. They are lying safely in your demat account. Mamta?
Okay, okay, okay. So tell me something, how does Smartvalues reflect the way you look at the world?
In many ways, it does. We have built a non-predictive model, which is based on the belief that we do not have the ability to predict or peer into the future. Since we do not believe that that we or anybody else has the ability to predict, we do not try. We also believe that the market has a message. It is important to believe that the market is giving out a message, and the most important thing to do is to understand the message rather than be distracted by all the noise that is generated by the market ecosystem. So we have taken care to ensure that these parameters that I just talked about are incorporated into our algo, and we think that that is what makes it robust and sustainable. Mamta?
Wow. Thank you so much for those, wonderful insights. I'm sure the viewers would be really excited and would be, once they get into the portal, I'm sure they can, register and see what is awaiting them, I guess. So thank you so much.
Thank you, Mamta. Thank you for hosting me. And like you said, I think once the subscribers register themselves, then they can open out and see what is available in the book. Thank you, Mamta. Thank you.
Thank you so much. Bye-bye.